Hi guys, welcome to the video. My name is CA Varshith Gowda and I am here to make your account a little bit easier. Yes. So today I'm coming with one more topic under your CA foundation accounts, and that is inventory. Correct? So today we'll be discussing about inventory. By watching this video, 100% your inventory, whatever unit you have, that you will feel a little better after watching this video. And I'll try my level best to make this topic little easier for you. Clear? So for that, as usual, I want you to watch this video till the end of this video, and I want you to watch this video with 100% attention so that you'll understand better. Is that very clear? Yes guys, so let's start with inventory. So what is inventory? Inventory, also known as closing stock. Correct? Also known as closing stock. So what is this closing stock? Just to give you a bare example, goods purchased but not sold. Goods purchased but not sold is your closing stock, that is inventory. Okay, but does inventory means only that? Does inventory means only goods purchased but not sold? No. If you go to your accounting standard 2, accounting standard 2 is that standard which talks about and which gives you accounting principles or rules as to how to account for an inventory. So accounting standard 2. So if you go to AS2, inventory means it is finished goods. WIP, what is WIP? Work in progress. Sir, what is work in progress? That means you have started to manufacture. Okay, you have started to manufacture, but the goods is not finished. Okay, it is finished only when the whole manufacturing process is done. Work in process is that thing which you have started manufacturing, but it is not yet completed within the year. Finished good means goods which are completed, goods which are finished with manufacturing process, which is ready for further use. Correct? That is your finished goods. This is your finished goods. Then inventory includes raw material also. What is raw material? Guys, for the process of production, you will use something as base raw material, and that base raw material is called your raw material, and that is also is considered as inventory under AS2. Then what else? Your consumables. So what is consumables? Guys, in the process of production, you'll use a lot of items which will get consumed in the process of production. For example, best example is your bubble wrap. Okay, sir, what is bubble wrap? If you see, once you produce the goods, correct, you have to package them safely with a bubble wrap so that nothing harm happens to them, correct? No? So these bubble wraps are what? Consumables. In the production process, they are getting consumed, correct? Or small screws, etc., that is used in the process of production, okay, to produce the unit. All these are consumables. It will get consumed over the period of production, correct? So consumables is also included under inventory. Then any goods purchased for the purpose of resale. Then any goods that is purchased for the purpose of resale. Okay, basically I'm talking about trading. Okay, in trading what happens, guys? That person, he will purchase for the purpose of reselling the goods. So those goods will also come under the definition of inventory. Whenever I say inventory in this unit, it includes all these things. Clear? Done. So that is inventory as per AS2. So what are we learning here? So basically the first thing we are learning here is valuation of inventory. Okay. So valuation of inventory andre, at what value we recognize closing stock in our books of accounts is the question. Okay, that is why we are learning this chapter. Sir, why valuation of inventory is important, guys? Because valuation of inventory is directly proportional to your profit. Okay, imagine your trading account. Okay, if you imagine your trading account from final accounts, okay, see, this is the T format, Here you will be having opening stock, 2 purchases you will have here, then you will have sales here, then you will have closing stock here, then you will get gross profit as balancing figure. Remember, this is how you get gross profit as per your trading account under your final accounts. Now say opening stock is 5,000, say purchases 10,000, sales is 20,000 and closing stock is 5,000. All are just hypothetical figures just to show you that gross profit is directly proportional to closing stock. That means what? If closing stock increases, gross profit also increases. If closing stock decreases, then gross profit also decreases, no doubt about it. Now how much is your gross profit? 25. 25 minus 15, your gross profit comes to 10,000 rupees. Did you see? Now, say you overvalued your closing stock. Okay. Say suppose the closing stock is 6,000. Now if you see what will happen, 26 minus 15, this will become 11. Did you see what is happening? The moment closing stock is increased by 1,000, your profit is also increasing by 1,000 rupees. Correct? No? Now if you make this 4, this will become 9. You can see. So understanding. So your closing stock is directly proportionate to profit. By mistakenly, if you overvalue the stock, your profit also will be overvalued and your assets also in the balance sheet will be overvalued. Both are not correct. It should not happen. That is why we are learning valuation of closing stock. Okay, very important. Now what is the point that we learned? Inventory. Closing inventory is directly proportional to profit. Very important. That is why valuation of closing stock is very important, guys. I don't want to overvalue my closing stock. Done. Then one more point. Okay. So we are learning valuation of closing stock. How is closing stock coming to books of accounts? That you have to understand. How will closing stock come to books of accounts? Now you know something, if it has to make its way to books of accounts, it cannot come directly. It should happen via journal entry only. How? Problem. So no problem. We have a journal entry. Okay. We already have a journal entry. See, if you see in trading account, for the first time closing stock appears in trading account only, if you have observed. Yes or no? Just think about it. Whenever we purchase, we are not debiting stock. Stock is an asset, asset increasing debit. Are we doing that? No. Directly we do purchases to cash or creditors. Whenever we are making a sale, are we crediting stock somewhere saying that stock is going? No. We will credit sales because it's income. Where are we showing the stock movement? No. The stock movement we are not at all showing. What we'll do is at the end of the year, okay, we'll go to our go down and we'll calculate the units that is there in my go down and I'll value it and bring it to books of accounts. Only in the end of the period, count my units and then bring those units to books of accounts. Clear? So say suppose I went to my go down, I found out that here in my example 4,000 was my closing stock. So what is the entry I will pass? Since I am incorporating closing stock into the books, my stock is increasing. Closing stock account, debit to trading account. Why sir? See, if you see here only trading account is credited, it's coming in the trading account credit side. So trading account will be credited in the journal entry. So 4,000, 4,000. So this is the entry that you will pass. Okay. Alternatively here, instead of crediting trading account, you can also credit purchase account. In this case also, you will get the same answer. Instead of showing it separately in the credit side, I am asking you to subtract from the purchase side. Both are same. Both will give you same answers. Okay. Clear? So this is the entry that you will pass to incorporate closing stock into your books of accounts. Later, this is an asset. It will go to balance sheet. Then, any doubt still here? No. Now, what's the next thing? The next thing is, one more important point why valuation of closing stock is important is because of matching concept. Okay. What does matching concept tell? Matching concept means your income or benefits during the year should match with the expenses. Your income and expenses should match while you are comparing. For example, say suppose I have sold 5 mobile phones for rupees 2000 each. So into 5 is equal to rupees 10,000. Okay, now this is my sales. I have sold 5 mobile phones at 2000 rupees. My total sales is 10,000. Now tell me, to arrive at profit, what I should subtract? Okay, I am telling you the cost of each mobile phone is rupees 1000 each. Okay, now this is sales. If I subtract cost from this, I will get profit, which is correct. But during the year, the total purchases that I have made is purchases of 10 mobile phones at rupees 1000, as I told about. Okay, I have purchased 1000 rupees, 10 mobile phones at 1000 rupees each. That means my total purchases is 10,000 into 10 rupees, 10,000. So sales 10,000, purchases, sales during the year 10,000, purchases during the year 10,000. So my profit 0. Is it? Is my profit 0? So just think about it. Okay, pause the video and think about it. Is my profit 0? Hey, no guys, no way. You have sold only 5 mobile phones and you are comparing that sales with the cost of 10 mobile phones. Excuse me. Understanding? You have sold 5 mobile phones and you are comparing it with the cost of 10 mobile phones, not matching. Your benefits, which is sales, should match with your purchases, that is your expense. So this is by default wrong. So what you will do? What you will do is, if you have sold 5 mobile phones, then rupees 2000 into 5, it becomes 10,000. Then you have to compare it with cost of 5 mobile phones only. Okay, which is 1000 rupees each. So 1000 into how much have I sold? I have sold 5 mobile phones only. I have to take cost also of 5 mobile phones only. 5 rupees, 5,000. Now if you see, my profit is 5,000. Is this correct? Is this correct? So my total purchases was actually here before. My total purchases here was 10,000 rupees. But here I have considered 5,000. Why? Because I am taking cost of only those mobile phones which is sold. So whenever you incorporate closing stock, matching concept is getting complied with. See, if you directly take purchases during the year, it becomes 10. It becomes 10. Sales during the year 10. Purchases during the year 10. 10, 10, 0. Profit is wrong. So when you pass this closing stock incorporation entry, okay, what will happen? See, in this case, I have told you credit purchases. Credit trading or credit purchases, both are same effect. Okay, now if you credit purchases, what is happening? Purchase is an expense, increasing debit. Here you are crediting means you are decreasing purchase by how much? This is an earlier example. So this is the entry that will pass. Okay, so my closing stock in my new example, this example, how much is my closing stock? Now I have to incorporate. Closing stock here is 10 mobile phones at purchase, no opening stock. 5 mobile phones is sold. That means my closing stock is 5 mobile phones at rupees. Guys, closing stock is taken at cost if nothing is sold, not at sales price. Okay, only sales is taken at sales price in your trading account. All other items will be at cost. So 5 mobile phones is remaining with me, 1000 rupees each. So it is 5,000 rupees is my closing stock. Now if you come here, I will pass the closing stock incorporation entry. So that is closing stock account debit 5,000 to purchases or trading, whatever, 5,000. The moment you pass this entry, purchase is getting credited. Purchase is an expense, increasing debit, decreasing is credit. If purchase is credited, that means it is decreasing. This entry will have the effect of subtraction from 10,000. My total purchase was 10. Here I am subtracting 5, because of which it became 5. It was 10 earlier. Why it became 5? Because I incorporated this entry and purchase is reduced by 5,000 and I got the actual profit. Understanding? Understanding one more reason why we are valuing closing stock, because to comply with matching concept. Clear? Now, okay sir, we understood why we are valuing closing stock. Now let's actually come to valuation of closing stock. Okay, before that, before actually going to valuation of closing stock, let me also teach you one more thing. Okay, now whatever we have learned, the finding out gross profit, I would like to put it in a formula version. So how will I generally find out gross profit? I'll take total sales made during the year minus, will I subtract the entire purchases? You just now know the logic. Will I subtract entire purchases? Hey, no sir, I will take the cost of only those goods that is sold. In the above example, I have sold only 5 mobile phones. I'll take the cost of only 5 mobile phones. Here also I'll take not the whole purchases, but cost of goods sold only. Okay, if I've sold 10 units, I'll take cost of 10 units. If I've sold 5 units, I'll take cost of 5 units. That's all. If I've sold 5 units, I'll not take cost of 10 units because that is not in compliance with matching concept. Just because you have purchased 10 units in the year, cannot take 10. You have to take only cost of those goods which is sold. Sir, how to find out cost of goods sold? Sales, you know, they would have given. You can easily find out. Cost of goods sold is opening stock, whatever you had in the beginning of the year only. Okay, beginning of the year, say suppose, again it's a different example, you already had 4 units. So opening stock plus purchases, that means during there, say suppose you have purchased 10 units. Okay, minus closing stock. Minus closing stock means 4 units I had in opening stock, and before starting of this year only 10 I have purchased, total I have 14. Total 4 from the opening, 10 I have purchased, total I have 14. Total purchases, total units that I should have is 14. Then I went to go down, I counted the closing stock. In closing stock I have 5 units. Guys, I was supposed to have 14, but if I go to closing stock, there is only 5 units, but that means what is remaining? What happened to remaining? From 14 it has become 5. So what is the remaining, guys? So remaining is 9 units. Where did it go? The only possibility of going is sales. Correct, no? So 9 units is sold. Okay, done now. Sir, one more possibility, purchase returns is there. If you have purchase returns, take net purchases here. Okay, that means take purchase minus purchase returns. Okay, clear? So 9 units, you are supposed to have 14, and I am assuming there are no purchase returns in this example. So you are supposed to have 14 units, and in closing stock if you have only 5, that means 9 units is gone. So 9 units is the units that is sold. So if you apply this formula, you are getting what? The details of cost of the goods that is actually sold, because opening plus purchase is what I am supposed to have, closing is what I actually have. What I am supposed to have, what I actually have. Difference is what? That means difference has gone out for sales. So easily if you apply this formula, the opening stock value plus net purchases minus closing stock, you will aramse get cost of goods sold. That value, cost of goods sold, please subtract it from here. So sales minus cost of goods sold, you will get gross profit. Clear, guys? All of you? Any doubt still here? No doubt, huh? Done. So ulta, can I draft this formula in one more way? See, closing stock, I am putting this the other side, is equal to opening stock plus purchases minus cost of goods sold. If you apply this formula, you will directly get closing stock. Only thing is, what did I do? What did I do? I just transferred this closing stock here and this cost of goods sold here. Okay, basic mathematics. The moment you transfer it there, your sign changes. Done. Now that is about all the things that you are supposed to know for the purpose of inventory. Now let's come to the next part. So what is the next part? The next part is valuation of closing stock. Now we have learned various reasons as to why the closing stock should come to books of accounts. Sir, at what value will we bring it to? I counted, sir. I went to go down. I counted. I have 25 units, sir. Can I put 25 units in trading account? Can I put 25 units in journal entry? No, in journal entry I have to put value. What value should I put? That we are learning here. Accounting standard 2 tells that your closing stock should be valued at cost or NRV, whichever is lower. You have to take cost of that particular inventory, then compare it with NRV. Compare both. Whichever is lower, take that value and value your closing stock at that value. Okay. Now let's understand what is cost. Okay. So cost means to acquire this inventory or to manufacture this inventory, whatever you would have incurred, please add all that. All the costs incurred to acquire inventory. Acquire inventory or purchase inventory, please take that. Then add all the costs of conversion. The cost of conversion, what conversion? Guys, in case of manufacturing, what will you do? Raw materials or WIP, that you will convert into finished goods, correct? No. To convert it into finished goods, from raw material to convert it into finished goods, what and all you'll spend, all that you please add it to cost of conversion. What are the examples? Raw material cost added. You would have given wages to labor to do the manufacturing process. Please add wages. Okay. Some big manufacturing industries will use plant and machinery for the purpose of production, correct? So add the cost related to plant and machinery. Sir, cost related to plant and machinery. How, sir? How is the cost of plant and machinery shown every year? Depreciation, correct? No, don't you think depreciation? What is depreciation? Depreciation is systematic allocation of the cost of the asset over the depreciable, cost Anthony. What is depreciation? Depreciation is the systematic allocation of the depreciable value of the asset, which is cost over the useful life of the asset, correct? You are allocating the cost of the asset over the useful life of the asset. So it is represented by depreciation. Whatever plant and machinery depreciation is there, you can add that also here in cost of conversion, because plant and machinery is very important to convert raw material into finished goods. Yes or no? Yes, 100%. Okay, done. Now what? And any other direct costs incurred to bring the inventory to present location or condition. So next is, along with cost of conversion, along with whatever cost is incurred to acquire, that is to purchase this inventory, whatever cost you have incurred, okay, to bring the inventory to the condition of sale. That means to bring that inventory to the condition of sell. Andre, see, the moment you take raw material, you start processing it and you make it finished goods, can you sell it off? No. Okay, not every time. Okay, till that unit comes to the position where you can easily now sell it. Now it is in marketable position, you can go sell it to people outside. Until that condition, okay, to bring it until that condition, whatever cost you have incurred, add it. For example, is packaging necessary to bring it to the condition of selling? Yes, you have to package it in a certain way, add packaging costs. Correct. Now other directly attributable costs to bring it to the location, that means to my inventory. Say suppose I have purchased some inventory and to bring it from supplier's premises to my premises, I have paid some transportation cost. Is it directly attributable? Yes, guys. Without paying the transportation expense, how can my inventory come to my present location? Without coming to present location, how can I sell it? No, not possible. So whatever I have paid as transportation cost is directly attributable for the purpose of acquiring, no doubt about it, correct? Yes. Next, all these are directly attributable costs. All the costs that is directly attributable to bring the inventory to present location or condition in which you can resell it to people. Okay, any directly attributable cost. Okay, For directly attributable, we have one criteria which I use generally. It is called, Kannada people would understand this, it is called Neenu illade nanilla. Okay, that means these are Neenu illade nanilla. In English it means without you I am not there. I know where your thinking and all is going, not there. Okay. Neenu illade nanilla means these direct costs are those kind of costs that you wouldn't have incurred only if you had not purchased inventory. Now let's come back to our example, the transportation cost. If I had not purchased inventory, do you think I would have paid transportation cost? No, that means it is direct. It is directly related. Without inventory, without purchasing of inventory, no incurring transportation costs. Understanding or not understanding? Yes. Now one more, one more I took was packaging. Yes. Just because I am producing goods, I am incurring packaging. Without production, will I incur packaging? No. So therefore, these are directly attributable. Please add it to the cost which I am telling in this criteria. Okay, cost or NRV. In that cost, you are adding all these things. Now one more special point I will take. What about storage cost? Storage cost. Will you add it? Storage cost means the cost that I have incurred to store the inventory. Now tell me, what did I tell about storage costs? Generally, about directly attributable costs. What did I say? All that cost that is incurred to bring the inventory to the present location or condition so that you can resell it to people, to bring it to that condition where you can resell. The moment you are done with manufacturing, packaging and everything, it is already ready to sell. If you want, you can sell it now. You are voluntarily storing it because there are no customers that are coming. But is it ready to sell as at that point of time when the packaging is done? Yes. The moment packaging is done, it is already ready to sell. So storage cost, if you see, it is not direct because it is, I told only those costs which have incurred from the point of acquiring or whatever it is till the date it comes to the location or condition in which I can sell it. Now it is already ready. I manufactured or I purchased, I have packaged it. Now it is in the format of ready to sell. It is ready, done. Then that's all I am supposed to. The point it is ready to sell, done. That is when I'll stop adding the costs. Storage cost is happening after the goods is ready to sell. Very important. The storage cost is coming after the goods is ready to sell. Yes or no? Now is it direct? Not at all. So therefore, storage costs, I will not add it. Storage costs, I will not add it to the cost. Very important. This might come as an adjustment noted. But there is one small exception, guys. In case of goods like wines, if you see what will happen, wines once you prepare, okay, you have to let it ferment for 1 or 2 years. The more years you keep it in a barrel, the more value it gains. Correct? Now here what is happening? To prepare wine only you have to store it for 1 year. Without storing it for 1 year, is it ready to sell? Is the wine ready to sell without storing it? No. It will become wine only when it is stored, and only when it becomes wine it is ready to sell. Without storing it, there is no way I can make it as a wine. Without making it as a wine, I cannot sell it. Now in this case, storage is important to make the goods ready to sell. In case of wine, in this case, I will definitely add storage costs also. But in normal cases, where storage is not necessary part to make the goods ready to sell, in those cases, I will not add storage costs. Clear? Any doubts? No. Done. So that is about your cost. Whenever I am saying valuation of closing stock, you have to value closing stock at cost or NRV, whichever is lower. In that cost, what all you are supposed to consider, all this we have discussed. Okay. Done. Sir, what all we should not consider in this cost? Yes, you have that also. Okay. Please don't consider abnormal loss. Okay. Abnormal loss. Yes, guys. Say suppose you have some inventory, okay, that is in your godown. Suddenly, or some raw material is there. Suddenly, what happened? Fire happened in the godown, and all the raw materials inventory is gone. Now, this is what abnormal, because suddenly fire happened. Is it normal event in your business? Every day fire happens? No, it is abnormal. Now, whatever which is burnt in fire is gone. That is my loss. These are abnormal losses. Am I supposed to add it to the cost of the inventory? No. Abnormal loss, please don't add. Sir, abnormal loss I should not add, you have told. Normal loss, guys, normal loss is something which we cannot avoid. For example, say suppose I am a manufacturer of paneer. Every day I am purchasing milk. While the milk is coming in the van, some percentage of the milk is 100% getting evaporated, and 100% is not entire of it is not getting evaporated. Say suppose over the, say out of 100% of milk that I have purchased, some 5% will go out for evaporation, will go in the air. Am I able to avoid it? No, I am not able to avoid it. I am not able to avoid evaporation. Now every day when I purchase, 5% will go for evaporation. Now this has become my normal loss which I cannot avoid. A loss which you cannot avoid becomes your cost. A loss which you cannot avoid, which eventually becomes your cost. Therefore abnormal loss I will not consider, but normal loss I will include it in the cost. Normal loss I will add it, but abnormal loss I will definitely not add it. Next, please don't consider selling and distribution costs. Guys, whatever cost that you incur for selling and distribution to make the goods reach much more places, these are not directly attributable for acquiring of inventory and all. These are not direct, so I will not consider it in the cost. Selling and distribution costs. Guys, the moment you produce the goods, it will be in go down. What customer will come to go down and purchase your goods? No, you have to give some money to distributors. They'll take the product, give it to retailers, then they will sell it. Okay, for this, of course, distributors will take some money. That will you add it? No, because it is not directly attributable. Then any general or admin overheads, I will not have. Admin overheads means, guys, admins means, people that you have employed for administration purposes. Okay, for example, if you take our academy, we have an admin team. There is a reception where as soon as students come, they'll talk to students, counsel them, then they'll take admission to whatever courses students wants to come into. Now admin people are just catering to customers of my academy. Okay, is it directly attributable to the purchase of inventory? Is it directly attributable to the manufacturing? No. So that's why I'm not including general and administration overheads in the cost. Okay, so these things please don't consider. Okay, abnormal loss, selling and distribution costs, general or administration overheads, okay, which you are paying as a salary for administration of an entity, like reception, people, accountants, all these people are whom they are administration. Is administration directly linked to purchase of inventory, selling of inventory? No. So their cost and all I am not adding into the cost, I will exclude them. Abnormal loss, I will exclude them. Selling and distribution, I will exclude, but normal loss, I will include it. Clear? So that is the cost component of your comparison. How will you value closing stock? You will take cost. In cost, whenever I say cost, all this you have to consider. Next comes NRV. Says NRV, what you have, before getting into the definition, I will tell you. By NRV, what you can understand is, understand it as a market price. Say suppose the cost of the inventory, that means the inventory you had acquired it at a cost of say 10 rupees, and NRV, understand NRV as a market price. Now 10 rupees is the cost to buy this asset for you. What is the cost to buy this asset inventory for you? It is 10 rupees. But the market value of this same inventory has become 8 rupees in the market. 10 is your cost, 8 is the market value. Okay. Now if you value your inventory at cost, which is 10, what is happening? You are overvaluing your closing stock, because market price offered is only 8 rupees, but you are valuing the same at 10 rupees, 2 rupees more, not correct. So that's why we have this principle of cost or NRV, whichever is lower. This ensures that your conservatism principle is complied with. So what is happening? Though cost that you have incurred for particular good is 10, your NRV, the market price is 8. So though I have incurred cost, okay, of 10 rupees, I will value the inventory only at 8, because what did the rule tell? Cost or NRV. Cost is 10, NRV is 8, whichever is lower. Which is lower out of the two? 8. So I will value my closing stock at 8 rupees. Understanding a conservatism principle. And also, if market value is 8 and your cost is 10, you are overvaluing your closing stock. Market value is 8 rupees. Your cost is 10. Now, if you value your closing stock at 10, what is happening? You are overvaluing your closing stock. Market only is ready to give only 8. Why are you showing it at 10? Wrong. If closing stock is overvalued, what will happen? I have already told you, closing stock is more. Closing stock is directly proportional to profit. If closing stock is overvalued, then profit is also overvalued, not correct. That's why what I am doing, I will take whatever cost I have incurred, I will compare it with market price. If my market price is lower, I will take that amount only. If market price, say suppose NRV in this case is 12, then 12 or 10, which is the lower? 10. Then I will value it at cost only. Basically, if my market price is more than cost, I'll value it at cost only. But if my NRV, that market price, is less than cost, then I'll value inventory at NRV, market price only. Clear? Done. So in cost, you have to incur all that. In NRV is estimated selling price. Okay, estimated selling price. Whatever inventory that you are valuing, no, you have to take the estimated selling price of that inventory minus estimated selling cost. Okay, say suppose we are into trading of some remotes. Okay, that remote estimated selling price is say 30 rupees. 30 rupees in the market, they are ready to offer 30. Now my manufacturing unit, okay, I just know trading, no, okay, my go down and all everything is in somewhere very far. Now if my go down is very far, will customer come to me and purchase that remote? No, what I have to do? I have to pay some selling cost, I have to pay some money to distribution people. Okay, without spending money on them, am I able to sell my goods? No, because my goods is somewhere far away in the go down. Without paying selling cost, how can I sell the goods? So tell me, if 30 rupees is what market is offering to me for a particular product, and 2 rupees I have to give it to selling people, because without giving to selling people, no way that goods will be sold. Will I realize 30 rupees without paying 2 rupees? No. For every 30 rupees, I have to pay 2 rupees. That means how much am I getting technically? For every 32, for you to earn every 30, you have to give out 2 rupees. That means your net earning is 28. No. So that's why what they are doing is, since selling cost is there for every unit that you are selling, okay, though market is offering you 30 rupees as estimated selling price, 2 rupees is an unavoidable thing. You have to pay towards selling. So my net is 30 minus 2, 20. Same effect we are doing here. Estimated selling price is 30. And my selling cost, without incurring selling cost, no way I can sell the goods. So that is 2 minus 2 minus further processing costs. Okay. Further processing cost. Now what is this further processing cost? In the question they will tell. Okay. Say suppose you are manufacturer or trader of remotes. Now what has happened is your estimated selling price is 30. Okay, no doubt. Your estimated selling price for this of this remote is 30. Selling cost is 2. I have subtracted. But the thing is, this remote what you have now, I have told you, inventory also includes WIP. WIP means what? Unfinished inventory. That means work in progress. You have started with the process of manufacturing, but the manufacturing of that product is not complete. Okay. Now say suppose that T was the total sales price minus 2 selling cost, that is also okay. But this is WIP. The inventory which I am considering now, valuing is WIP. That means I have incurred all the manufacturing cost towards it. Just think about it. Say suppose to manufacture a complete finished goods, me as an entity, I am supposed to incur 15 rupees. Then only my production is complete. But here in WIP, do you think I would have incurred entire 15 rupees? No, it's WIP. Maybe I would have incurred only 50%, maybe. So that means maybe I have incurred only 7.5 rupees. Okay. The product in itself is half done, no? WIP is what? Half done. Okay. But this 30 rupees which I am considering for the purpose of NRV, is that the selling price for half done goods? Is 30 rupees a selling price given in the market for half done goods? No. The 30 rupees was for the finished product. Now for valuing WIP, tell me how can I use the selling price of the finished product? Correct, no? If I had NRV of unfinished product, and that if I compare, good, correct. But this 30 rupees, this estimated selling price, this is for finished product. So what I have to do? This I have to make it equal into WIP. So what I'll do? Say suppose I'm valuing WIP and only 50% is done. Okay, that means still 7.5. Total 15 I'm supposed to incur to produce. Out of that 7.5 already incurred. Still 7.5 yet to be incurred. Correct? No. So what I'll do is I'll also subtract further processing cost. Now tell me, with respect to this WIP which I am valuing, 30 was the estimated selling price minus 2 cost to sell minus what is the further processing cost? That means to make this WIP finished. Okay. What is the further cost that I am supposed to incur? If you see 15 is the total, I have incurred only 7.5, that means I have to further incur 7.5 rupees to make the goods complete. So that is further processing of cost. That also I will subtract. Now I got the NRV of WIP. So 30 minus 2, 28. 28 minus 7.5, it is 20.5. Now this is the NRV that I will consider for WIP or for goods which requires further processing. Understanding? This NRV was market price. Okay. For me, for particular remote, okay, my market price is how much? 30 rupees. Minus how much is my cost to sell each unit? That I have to give to distributor. Without giving that, I cannot realize 30 rupees. So from 30 minus to 128 is what I receive. Okay. Now the thing is, I could have taken 28 as NRV, but am I valuing finished goods? No, I am valuing WIP. WIP is half done. For half done inventory, how can I take NRV of completed goods? How can I take estimated selling price of completed goods? Not correct. The moment I subtract the further processing cost, in this case 7.5 I have incurred, still 7.5 yet to incur. Only if I incur that remaining 7.5, my goods is complete. So whatever further processing cost is there to make the WIP FG, that also I will minus it from NRV, that estimated selling price. Now I will get NRV for unfinished goods. Now it is comparable. Now compare this 20.5 with the total cost incurred on the WIP and take whichever is lower. So what is your NRV? Basically estimated selling price for the finished product minus selling cost minus further processing cost will lead to NRV, net realizable value. That's all. NRV is nothing but, for your understanding, market price. That's why they have got estimated selling price minus selling cost. Without incurring them, no way I can sell the goods, minus further processing cost. Okay, because the estimated selling price I am taking is for finished goods. Okay, then I cannot take the estimated selling price of finished goods and compare it with goods which still requires processing. That's why what am I doing? From the estimated selling price I am removing further processing cost. Now the NRV becomes comparable. I'll use that NRV for the purpose of valuing the inventory. Clear? So that is done. Now you will value inventory at cost or NRV, whichever is lower. Now we have learnt what is cost, what is NRV. Correct? Done. Now let's enter to the next point. Now we are done with valuation of inventory. Just now we learnt it is cost or NRV, whichever is lower. Done. We are almost done with the valuation of inventory. But now one problem came. Okay, I'll tell you what is the problem. You tell me. Now I'll value the inventory and everything. Now let's imagine a situation where I have done multiple purchases at different purchase price. Say suppose in a year, in January, I am assuming the year to be January to December, your financial year. In January I have purchased 1000 units at rupees 10. Same 1000 units. In Feb I have purchased 2000 units at rupees 11. These 2000 units, same guys, same units. These 2000 units whatever I have purchased, this 1000 units whatever I have purchased, both are same. They are identical. Interchangeable. Okay, that means what? So when you purchase at different prices, you will take all the purchases, put it in one, go down. Okay, and when customer asks it while you are selling, okay, you take that inventory. Now you have two lots, same inventory. Okay, same goods. One you have purchased on January, one more you have purchased on February. No matter from which lot you will give, okay, customer will take it. Customer doesn't care all that. These are interchangeable. Okay, any goods in the go down you can give, customer is satisfied because that is what customer wants. Interchangeable. Instead of taking a particular unit which is there in the starting of the go down, say suppose you want to give the inventory which is there in the starting of the go down, you will give it, doesn't matter. You give the unit that is there in the end of the go down, you give it to the customer, doesn't matter. Interchangeable, give anything. All are same units, okay, same items. Okay, Jan I have purchased at, but if you see prices are different. One I purchased at 10, one more I purchased at 11, good. Now, what happened? 1500 units. 1500 units is sold. Since everything was interchangeable, what did I do? I went to go down, simply took some 1500 from randomly I took. I did not make a bifurcation. This is 1000 lot which was purchased at 10 rupees. This was 2000 units. This was purchased at 11 rupees. All that bifurcation I did not do. Simply I took 1500, sold it to customers. Done. Okay. Now what happened? Now I was supposed to calculate my closing stock. How will I calculate my closing stock? I will go down, count the number of units. How much units will be there technically? You have purchased 3000, 1500 is sold. That means how much will be remaining? Of course, only 1500 units will be remaining. Okay, that is correct. At what value shall I take this 1500? Shall I take it at 11? Shall I take it at 10? Problem was that because it was interchangeable, I have just taken it and I have given. Now I don't know. In the closing stock that I have, that is 1500 units, how much pertains to 10 rupee purchase, how much pertains to 11 rupees purchase? I don't know. I have just given off the goods. How to value? If I knew, I would have taken the respective costs. Now if I knew that out of 1500, okay, 800 pertains to 10 rupees goods and 700 pertains to 11 rupee goods. And I know everything, I value it at that cost good, but I don't know. I went to go down and simply issued the goods. Problem, I don't know how much pertains to 10 rupee purchase, how much of the 1500 pertains to 11 rupees purchase. It's a problem. So this was the problem. So this problem, you know how they addressed with some assumptions. Okay, they addressed this problem by using some assumptions. First assumption, FIFO. Second assumption, LIFO. Third assumption, average. Okay. More than assumption, it's kind of like assumption only, but this is the policy used to address this problem. The first, this thing is FIFO. First in, first out. So what am I understanding here? So in FIFO, what I am understanding is, as per FIFO policy, okay, goods which came first, okay, goods which came first within the entity is going out. When will goods generally go out? For sale, okay. So what I am assuming here is, goods which came first only has left first. This is the assumption I am doing. Is that what has happened really also? No, I don't know. But the assumption I am making is FIFO. The goods which have come first would have left first technically, so I am taking that assumption. Okay, so what will I do? So if I take this example, if 1500 is sold, that means the first 1000 would have gone from first lot, okay, and the remaining 500 would have gone from the second lot. So in this lot anything remaining? No, 0. In this lot anything remaining? Yes, only 500 was touched from this lot. Still 1500 unit is remaining from the 11 rupees lot. So I will value the entire 1500 at 11 rupees. Clear? So what did I do? The goods which have come first, in this case these are the goods which came first, 1000 units. So that would have left first. So out of 1000, 2000. Okay, 3000 is the total thing that we have. 1500 is sold. So first it would have gone from the goods which came first in January 1000. Second 500 would have gone from second lot. So whatever is in my go down will be the latest purchase only, which is 11 rupees. So I am valuing it at 11 rupees. That is your FIFO. Then we have LIFO. LIFO is last in, first out. So what is LIFO? LIFO is last in, first out. So what is happening here? In LIFO, the goods which have come last will go first. That is the assumption. That means the latest purchase will be sold and the goods which are bought first, that will stay in the inventory. Ulta of FIFO. Last goods which came in is going first whenever it is getting sold. So as per that assumption, what will happen to the same example? For that assumption, 1500 is the goods or units that have sold. Guys, I am talking about the 1500 units that have sold. So it would have gone first from where? So the latest goods that is the 11 rupees lot, because it was purchased the latest, that is in February. So as per LIFO, the goods when sold will first go from the latest lot. The latest lot is February lot. So 1500 will go from, entirely will go from second lot only. So how much will be remaining? 500 units will be remaining. Out of 2000, 1500 entirely gone from the latest purchase. Still 500 is there, which will be valued at 11 rupees. And January lot is untouched. January lot is untouched because what did I tell? The goods which came last went first. The goods which was bought first in January, that is still there in the go down. Entirely 1000 units into rupees 10. This is how I'll value my closing stock. So this becomes 10,000 and this becomes, so total it is 15,500 rupees. That is your LIFO. Okay. And then comes average. Average can be further bifurcated into two more parts. That is your simple average and weighted average. Okay. Now what is simple average? What I'll do in simple averages, I'll take the average price. Now I don't know FIFO, LIFO and all, difficult for me to do. Under this I'll just take the average price. Okay. What are my different purchase price? 10, 11. Okay, I'll take both the prices. And I'll do a simple average. Simple average means all the prices will have equal weights. So what I'll do? Easy to do simple average. What are the prices? Different prices available in my purchases? One was 10 and one was 11. I'll add both. Divided by number of prices that is available. 10 plus 11 divided by number of prices. Number of different purchases that I have made. 2. So it is 21. 10.5. So 10.5 I will use to value my closing stock. How much is my closing stock? 1500 sold. That means remaining is 1500. I value this 1500 at 10.5 rupees. Clear? Simple. I've taken my average price. I took both the prices that is there, different purchases, divided by number of purchases. I got the average price. At that average price I valued the inventory. Clear? Next. Weighted average. So what is happening in weighted average? Here we are still calculating an average price only, but we are giving weightage to the quantity. Okay, that means I am giving weightage to that price, okay, in which the purchase is of the highest quantity. Okay, say suppose I have procured or I have taken 100 units. Okay, 99 units have purchased at 90 rupees. 1 unit have purchased at 50 rupees. Now tell me which price I should give more weight. Majority of the purchase is done at 90 rupees. Only one is purchased at 50. That means weightage should be more for the majority purchase. Don't you think? So that's why what we are doing is in weighted average method we are giving more weight to that price in which more purchase is made. So finding out this is simple. How to do it? How to do this is simple. Now what are the purchases that I have made? I have made 10 rupees purchase for how many units? 1000 units. Okay. Then I have made 11 rupees purchase for 2000. Correct. Multiply 10,000. This also multiply. How much you get? 22,000 divided by, take the total, just multiply 32 divided by total units is 3000. So 32,000 divided by 3000. So how much it is? So it is 32,000 divided by 3000. So it comes to 10.67 rupees. At this price, now I will value my closing stock of 1500 units. Done now? Understood? That is how we use weighted average. Clear? Awesome. Now what to do? Guys, in one more thing, and the last thing that you are supposed to learn here is the different methods of inventory taking. You're supposed to learn different methods of inventory taking. There's two methods. One is periodic and one more is perpetual. Sir, what is this, sir? Periodic, perpetual? So, you know what this is? Now, till now, how did inventory valuation happen? Okay, what we did is closing stock, the assumption that we are having here is the closing stock detail is not maintained in the accounts in the first method. I'm talking about periodic. Okay, the assumption is the closing stock is not recorded in accounting software only. That means in your accounting software you are recording only Purchase and sales. Is closing stock details there? No. For closing stock, what we were supposed to do? You have to go down. Whenever you want closing stock, you have to go down, count it. Then only you will come to know about closing stock. Your accounting software is not maintaining it. That is called periodic basis. Periodic inventory taking means whenever you need the information of closing stock, you have to literally go to the go down at the end of that period and you have to count that number of units. Then only you will get closing stock details. That is periodic. So in periodic, what is happening? Will you immediately get closing stock details? No. Whenever you want to understand closing stock, what you have to do is at the end of that period, stop the business. Because if you don't stop the business, in between goods will be coming in, going out problem. So you have to stop the business, do the inventory counting, then only you will get closing stock. Okay. Whenever you are doing inventory counting, then only you will understand how much inventory you have. That is periodic. Perpetual means completely ulta. Your accounting software is only maintaining stock details also. No need to count and everything. The moment you make purchase of 10 units, it will add 10 units. The moment you sell 5 units, it will subtract 5 units. Now closing stock, remaining 5. Again you purchase 20. Now total closing stock is 5 plus 20, 25. Out of 25 you have sold 10. 25 minus 10, remaining is 15 units. Understanding? The moment you are doing purchase and sell, your accounting software is automatically recording everything. So that is your perpetual. In perpetual inventory taking, what is happening? We are not waiting till the end of the period to do inventory counting. Your accounting software is only recording everything and it is getting updated real time. So that means in periodic, the moment you make purchase, do you get the closing stock? No. No matter you do how many purchase, how many sales. Whenever you want inventory, you have to go down and you have to count. But in perpetual, all that problem is not there. The moment you make a new purchase, closing stock is updated. The moment you make a sale, closing stock is updated. Yes or no? 100% yes. Done. Now that is your different methods of inventory taking. Okay sir, we understood. Periodic is we are doing it at the end of the period. Perpetual is real time updation. It is taken care by accounting software. Sir, why are we learning this? Very important, guys. While determining, okay, now whenever in the question they'll ask you, find out the closing stock by using FIFO, LIFO or average method. Something they will ask, okay. Now whenever they'll ask this, the first question you have to ask yourself is the entity using periodic inventory taking or is the entity using perpetual inventory taking? Very important. Based on this, your answers will differ, okay. Because what happens in periodic, we are doing it in the end of the period, okay. Now let's take a small example. I'll just give you how periodic perpetual differs, okay. Now let's take this example. These are the different dates at which I have purchased different quantities. All are identical items only. And if you see, the prices are different. Guys, LIFO, FIFO will come into picture only when multiple purchases are made at different prices. So if you see, multiple purchases are done at different prices, okay. Now they want us to find out the closing stock via FIFO method, okay. Now two things are possible. One thing is they are following periodic inventory taking, and one more thing they are following is perpetual inventory taking. Sir, how will it matter in periodic? In periodic, I am doing closing stock only at the end of a particular period. Now here it is December, okay. If you see record of issues means sales, okay. If you see 4th purchase, next 10th, before 10th there was on December 5. In December 5 there is one sale happened, okay. In between, if you see, there is one sale that happened. In December 2029 sales have happened, okay. The beauty of periodic inventory taking is I am doing inventory taking in the end, okay. So how will I do? In the end, I go down, I will calculate the units. So I will get how much units I will be there. Technically, that we can understand from here only. When you go down, technically how much units will be there? I am talking about units, not the value. Units you can only see the total you have purchased in total December. Guys, imagine. Please understand, in periodic I am doing inventory taking periodically at the end of December. When all the purchase sales has happened, see, all these purchases has happened, all these sales has happened, in the end, December 31st, I am doing inventory taking. So how much inventory I will have? 2600 I have purchased, 1600 I have sold. So 2600 I have purchased, 1600 sold. That means how much will be there in closing stock? 1000 units. Simple. Sir, but we don't want units, we want value. Correct, we want value. So this 1000 units under periodical, guys, I am not, what you have to understand is in periodic I am not worrying about sales information given. I don't care. Okay, see what has happened, purchases has happened. We are doing this inventory taking for periodic. Under this periodic system, we are doing inventory taking for December. Okay, within this December there are some purchases, there are some sales. But will I consider the sales? No. I am directly calculating closing stock at the end of the period, which is 31st December. I will not consider sales. I will see, I will go to the end. Okay, in the end, I will directly see, I have understood that there is 1000 units. Okay, sales information and all I don't take. I don't consider. Okay, all the sales that has happened, I have considered it as together. Once, 1600. In between dates and all, I will not care because it is periodic. I am not doing inventory counting for every day. I am doing inventory counting for the end of one period, which is 31st December. Now, sales is not relevant only for periodic because I am, however, doing inventory counting in the end. Why take the sales that has happened in the middle? Am I doing inventory counting in the middle? No. So, what I will do is 1000 units is the units that I am supposed to value. Sir, but at what price is the question? For that, they have asked you to follow FIFO. So, what you will do is, this is the purchases. Okay, FIFO means first in, first out. Goods which have left. Okay, the assumption that I am doing is goods which have come first have left first. So, out of 1600 units that I have sold, 900 would have gone from this lot. Remaining 400 would have gone from this lot. 900, 400, 1300. Remaining 300 would have gone from this lot. First in, first out. So, all the three lots gone. Because I have told the goods which have come first have only gone. 1600 has gone. So, that means the remaining is this 2 and the closing stock is 1000. If you see 200 plus 800, 1000. So, I will value at these prices. If these have gone, that means what is remaining in the inventories? This. So, I will value closing stock at 200 into 60, 800 into 47. These are the goods remaining. You have taken the respective price. So, 200 into 60 will come to 12,000 and this 800 into 47 will come to 37,600. Total is 49,600. So this is how we'll do in periodic. So this is how we did before also. Simple. Here guys, for periodic I am not considering sales. That is only the logic. Sales information, whenever sales has happened, I will not consider. Directly take the price as only purchase information. Do whatever we have learned. In perpetual, okay, in perpetual it will be a little change. Okay, for perpetual, sir, what is happening in perpetual? You have to understand that first. In perpetual, FIFO, LIFO, whatever logic we are applying, in this case FIFO, we are applying. But are we waiting to apply this FIFO till the end of the period? Hey, no. The moment new purchase happens, your accounting inventory gets updated. So FIFO also should happen at that point of time only. Whenever sales happens, immediately FIFO should happen. Again, when purchase happens, FIFO. Sales, FIFO. FIFO is happening whenever a purchase and sale is happening. We are not waiting like this till the end of the period to apply FIFO. So let's see FIFO under perpetual method. Okay. So particulars. Receipts, issues, balance, quantity, rate, price, quantity, rate, price, quantity, rate, price. Okay. So what am I doing here? On December 4, I have purchased 900 units for 50 rupees. December 4th, 900 units for receipts. I am putting it under receipts because purchases are goods receipt, issues are goods sold at 45,000. Any issues on that day? No. So balance of goods is same, 900, 50, 45,000. Next, December 10th, but before going that, one small thing has happened, sales has happened. So will it get automatically updated? Yes. So December 5th. Any receipts? No. But 500 units are sold. At what price? Sir, selling price. Hey, selling price will not put because inventory should be maintained at cost. So 500. What will you use? Guys, there is only one price. No, nothing to apply FIFO, LIFO, ಅದೆಲ್ಲ ಮ್ಯಾಟ್ರೇ ಬರಲ್ಲ, ಯಾಕೆಂದರೆ ಇರೋದೇ ಒಂದು ಪ್ರೈಸು ಆಸ್ ಆಫ್ ನೌ. So I'll take 50 only. And of course, this 500 would have gone from this 900 lot, which is purchased for 50. So 500 into 50, 25,000. So remaining is 900 minus 500, 400 units. So it becomes 20,000. Guys, there was no multiple prices only, so no confusion. Purchased at 50, issued at 50. Next on December 10th, I've purchased 400 units at 55 rupees. On December 10th, I've purchased 400 units at 55. That means it is 22,000. Correct? No? Any issues as on that day? No. So balances, earlier we had a balance of 400, 50, 20,000. This is nothing but I've taken this only. And the new lot, 400, 55, 22,000. Yes, I'm not clubbing. If I club, it will become weighted average. No, I'm doing FIFO. So separate prices, I have to maintain it separately. So next, what has happened? 10th. On 11th, 300 units at 55 rupees. On 11th, I've purchased 300 units at 55 rupees. How much? 16,000. Okay, just a second, I'll take one. So it is, what was the date? 11th December. Okay, 11th December, 300 units at 55 rupees. That comes to 16,500. Any issues that day? On 11th? No, the next issues happened only on 20th. So if you come here, my updated balances: first 400, 50, 20,000. Second, 400, 55, 22,000. The third, 300, 55, 16,000. Done. Next, what has happened? Next, on 19th, I have purchased 200 units at 60 rupees. Again, 19th, 200 units at 60 rupees, which comes to 12,000. Okay. So again, balances 400, 50, 20,000, 400, 55, 22,000, 300, 55, 16,500, and new purchase here, 260, 12,000. Done. Next, what happened? Next one, sales. Now see here, on 20th one sales happened, so no purchase on that day. Sales of how many? Sales of 600 units has happened. Guys, now tell me, will I wait till the end of the period ends at 31st December? Now to apply FIFO logic, will I wait till the end of the period? No, we'll apply it now only. That's why it is perpetual. Then and there FIFO LIFO happens whenever sale purchase is happening. Now tell me, the goods issue of 500, from where? From which lot will it go? Under FIFO, the goods which is bought first will go first. So the 600 would have gone 400 from this lot, 200 from this lot. So 400 would have gone from the first lot at 50 rupees, and 200 would have gone from the second lot, that is 55. 55 to 200 is 55 to 200 is 11,000. So the balance, so this is gone. In this we still have 200 units at 55, that will come to 11,000. Then the other two is untouched. 355, 16,500, 260, 12,000. Done. I have applied FIFO then and there. Then what happened? On 28th, one more purchase. How much? 800 units at 47 rupees. 800 units at 47 rupees. 800 units at 47 is 37,600. Any issue? No. So balance, take on. Whatever balance is there, no, these three. Take it like that only to down. 200, 55, 11,000. 300,
55, 16, 500, 200, 60, 12,000. The new lot 800, 47, 37, 60. Done. So finally on 29th one more sales happened. Okay. On 29th one more sales happened. Any issue receipts? No. Issue 500 units at, but to decide that we have to apply the concept of FIFO. So come here. So the 500 units which is sold in the end would have gone out from first lot, 200 would have gone out from here, 300 would have gone out from this lot. That means the remaining lot is 200 and 800. 260, 12,000. So 200 it would have gone out. Issues would have gone out from first to two lots. That is 255, 11,000. 355, 16,500. So 255, 11,000. Then 355, 16,500. 355, 16,500. So these are the issues. Okay. So remaining. So FIFO. Out of 500, 200 would have gone from here, 300 would have gone from here. Remaining is 260, 12,000. 260, 12,000 and another day. So here, sorry, 260, 12,000 and 847, that is 7,600. 847, that is 7,600. So my total is 49,600 is my closing stock under FIFO, under perpetual inventory taking. So same logic, same FIFO LIFO we are applying in both. In periodic we are applying it in the end. And are we considering sales and other stuff? No, sales we have considered it as one total amount. That's all. Dates and all in between, all that complication will not consider, because it is happening periodically. I take periodical purchase minus periodical sales is equal to my closing stock units. And for doing FIFO LIFO, directly just take purchase details. Sales details I am not at all concerned under periodic method. But under perpetual, I am concerned with sales details also, because the moment sales is happening, FIFO is also happening at that point of time only. So understood how periodic perpetual changes? Done. Okay. Now, so now what we'll do is, for the same example, we'll also calculate closing stock based on weighted average method under both periodic and perpetual and see how it will differ. Okay. Same example. So same example we'll take. Okay. Now we'll be doing it. We'll be finding closing stock via weighted average method under periodic and perpetual. Okay. So what was the logic under periodic and perpetual? What did I tell? See, for periodic, please don't see sales. Forget sales exists. Okay. Forget sales exist. Only we'll take the periodic sales together. Okay. So how much is my closing stock now? If you see 2,600 total purchases, 1,600 total issues. So closing stock is 2,600 minus 1,600. So it is 1,000 units. Now the question is, at what value I am supposed to value this 1,000 units? So for this I am using weighted average. Now to find out weighted average, will I see anything in sales? Though sales has happened in between, will I consider sales? No. I'll forget sales exists for periodic. Now what I'll do? I told you simply multiply everything. Okay, multiply price and units. So this is 45,000. This is 22,000. This is 55 into. This is 16,500. This is 12,000, and this is 47 into 800. This comes to 37,600. So what is the total? So total is 37,600 plus 12,000 plus 16,500 plus 22,000 plus 45,000. So this is 1,33,000. Now I have to find out weighted average price. Take the total 1,33,100 divided by total number of units. Total number of units I've purchased is 2,600. So by 2600 you'll get 51.1. Okay, this is the weighted average price. How did I do? Multiply everything divided by total number of units purchased. So I'll value this 1000 units at 51.19. So it is 51,190 rupees. That's all. Periodic is done. Let's do the same closing stock using WM under perpetual. Here, will WM happen like this in the end, considering all the prices? No. Whenever purchase sales, whenever each purchase is happening, then and there, WM logic is being applied. We are not waiting till the end of the period. So, let's do it off. Okay. The format will be same only. So, I'll take the same format. Okay. So, one by one. First purchase has happened at December 4. So, December 4, how much? 900 units at 50 rupees, total 45,000. No issues as on that day. Balance is also 950, 45,000. Next, on 10th December, before that, one sales has happened. December 5th, 500 units. 5th December, no purchase. Quantity 500 units. Sir, what to do? What rate? Guys, here if you see, there is no question of multiple rates only as of now, because the purchase, only one purchase has happened and it's perpetual. WM is done at that point of time only. Okay, and also one thing is that, and second thing is there is only one purchase, 50. So issue also would have happened at 50 only. So 500 into 50, 25,000. Remaining is 400. So 400 into 50, remaining would be 20,000. So no question of WM or FIFO, because there is no multiple price only as at that point. Next, on December 10th, we have one more receipt which is for 400 units. So 400 units at 55 rupees would be 22,000. Correct, no? Now issues? No issues. Sir, no issues. Now I have to write down the balance. Here, will I do it like FIFO, separately will I maintain? No. Now I can club it, because however I am finding out weighted average price. So what I do? Weighted average will happen now only. So 20,000 will take the latest balance, 20,000 plus the new 22. 20 plus 22, total value became 42,000. Number of units? We had 400. Now we have got 400. Total units has become 800. So find out WM, 42,000 by 800. So you got 52.5. See, WM happened now only. There are other prices. See, in periodic we did weighted average in the end. We took all the prices here. Then and there, the moment purchase sale is happening, weighted average is happening. This is the weighted average price as of these two purchase and sales. Clear? Next what happened? Next on December 11th we have purchased 300 units at 55 rupees. So it is 16,500. Any issues? No. Now what you will do? Add the value. 42,000 plus 16,500. 42,000 plus 16,500, it comes to 58,500. Then units we had 800, 800 plus 300, 1,100. So 58,500 by 1,100, it comes to 53.18. Okay, 53.18. Done. Next what happened? On 19th, 200 units at 60 rupees, which is 12,000. So same thing. Add the total value, 58,500 plus 12,000. So it is 70,500. I'm adding this value and this value. The number of units, 1,100 plus 200. It has become 1,000 300. So 7500 by 1300, it comes to 54.23. Done. Next, what happened? Next one, sales happened on 2012. No purchases, but we have sales of 600 units.
Sir, what price to consider here? Guys, in weighted average method, the price that you'll consider for issue is the latest calculated WM. Here many WM we have calculated. The latest calculated is this 54.23. I'll take that only for the issue. So 600 into 54.3, 600 into 54.23, that comes to 32,538. Done. So the balance is 1300 minus 600, balance will be 700. So this will be 54.23 only, because average did not change. We have issued it also at the same average. Or best thing what you can do is 770, 500 you can subtract. From 70, 500 subtract 32, 532, 32, 538, you will get 37,962. This 37,962, if you divide by 700, you will get 54.23. Same number you get, because we have issued also same average. No, average did not change. Then what happened? On 28th, one purchase 800 units at 47 rupees. 800 units at 47 rupees. So how much? So it is 37,600. No issues as on that day. How much is the total value? 37,962 plus 37,600 plus 37,962. 30. Give me a second. Later. Okay. So 37,962 plus 37,600 divided by how many units? This becomes 75,562, and the 700 plus 800 this will become 1,500. So 75,562 by 1,500 becomes 50.37. Done. Now what has happened on 29th? One more issue has happened. 29th, we have issued 500 units. So no receipt. 500 units at the latest available weighted average price. Which is the latest available weighted average price? It is 50.37. 500 into 50.37. So it is 500. 25. 187. Okay. So the balance will be, balance is 75,562 the total value minus 25, 187, that is 50,375 units. 1,500 minus 500, remaining will be 1,000. So my average will be same 50.37, because we should also add same weighted average price. No, the weighted average price has not altered. It has been 50.37. So I will value my closing stock at 50,375. So as per periodic, you got it as 51,190. As per weighted average under perpetual, I got it as 5375. See, both cases weighted average only, but under periodic it differed. Under perpetual it differed. That's why it is very important. I hope you have understood how periodic and perpetual is working. Clear? Done, guys. Done. Now one more point, let's try to understand. What is one more point? Now to find out, ultimately what we are doing here, we are trying to find out closing stock value. There is one more method to find out this closing stock value, that is adjusted selling price method. See, ultimately what we are trying to find here in all the methods, LIFO, FIFO, no matter what, we are trying to find the cost of the closing stock. Correct? No, in all the methods, FIFO, all that assumption we are doing why? To what price I'm supposed to apply for the closing units. To determine that, we have different assumptions, FIFO, LIFO, correct? No. So there is one more method of finding the cost. Ultimately, we are finding the cost. In this method also, we are finding the cost. There is one more method. What is it? You already know sales price for a particular good. Don't you know the sales price? Yes, we know the sales price. From that sales price, subtract the profit component. From sales price, subtract the profit component. Then what will you get? From sales price, if I subtract profit, then whatever is remaining is my cost only. So didn't I get the cost in this way also? Yes. So this is one more way of finding the cost of the inventory. Take the sales price of the inventory. From that, subtract the gross profit. You'll automatically get the cost of goods that is sold. The cost of goods that is there. Clear? Right. So this is one more method. So let's take an example under this method also. Okay. Come on. Let's take this 7th one. This is finding out under adjusted selling price. Simple. You have sales price. Okay. Take sales price. From that, if you subtract profit, you'll get cost. Apply that cost and find out value of the closing stock at cost. Okay. Now, if you see, they have given us various things. We'll see what it is. Okay. Now, goods received from suppliers. How much? 1575, 500. This is nothing but my purchase. Okay. And they have given one more thing. It is subject to trade discount and taxes. They have given trade discount of 3% and they have charged sales tax of 11%. This both is not considered in this price. So what I have to do? I have to incorporate. So how to incorporate? From 1575 500, okay, please subtract minus 3% because trade discount should be subtracted. We will not bring trade discount to books of accounts. We will directly record purchase only at net. Then we have sales tax of 11%. Immediately add 11%. Okay. So what you will do? 1575 500 minus 3%. Okay, plus 11%. You will get 1696 340. Okay, when you consider minus 3% plus 11%. So this is the purchases that you have to consider. Next, packaging and transportation. Is it direct expense or indirect expense? Guys, I am talking about packaging and transportation and the inward transportation, the raw material that you purchase. For that you would have paid some transportation, whatever you have goods received. For this you would have paid some transportation. Is it direct? Yes. If it is direct, will it come in trading account or P&L account? Guys, it will come in trading account. All the direct expenses will come in trading, indirect expenses or income will come in P&L. So this is a direct expense which will come in P&L. Okay. So one more thing. Sales. Okay, done. Then they have given closing inventory. Guys, closing inventory should generally be at cost. If you remember your final accounts also, when you prepare trading account, closing stock is shown at cost only. But here see, they have given sales price of closing stock. Can I include sales price of closing stock? No. What I have to do? From sales price I have to convert it into cost price. Then that value I can use it in trading account. Okay. Find out the historical cost under adjusted selling price method. So now they have given sales price. Now from this sales price, now that means if they have used sales price to calculate the closing stock, that means that sales price includes profit component. From this closing stock, if I subtract profit component, don't you think I'll get cost? Yes. But have they given us profit component? No. They have not given us profit component also. Have they given us profit percentage at least? If they had given me profit percentage like GP margin is always calculated on sales. I could have applied that GP margin on this amount and I could have found out profit. GP margin is always calculated on sales and closing inventory is also at sales price. I could have multiplied that GP margin and I could have found out profit. But in the question, have they given you the GP margin? No. Array. Nothing they have given. How to find out? At least if they had given me GP margin, I would have found out profit. Now, that means we have to find out GP margin. Okay. Now, what is the formula for GP margin? It is gross profit divided by, always GP margin is calculated on sales. Gross profit by sales into 100. Okay.
But here we don't know gross profit also. How to find out gross profit? Guys, where will you get gross profit? If you prepare trading account, you'll get gross profit, correct? So let me prepare one memorandum trading account, because there only I will get gross profit. You have seen. You'll write now gross profit carried down, gross profit brought down, then you'll start with P&L. So particulars, rupees, so let's try to fill this up. Opening, no opening stock, leave it. Next, what will come in the debit side? Two purchases will come. How much is my purchase? I just now calculated 16,96,340. 16,96,340. Then I've already told you direct expenses will come in trading account. Indirect expenses will go to P&L. So 2. Because sir, why are we preparing trading? Guys, gross profit will get in trading account only, no? Simple. So 2. Direct expenses, that packaging and transportation we had. Now how much is that? That is 87,500. Then we require sales. How much is sales? Sales they have given 2245 500. 2245 500. Correct? Then what is one more thing that will come? Closing stock. Then this side will get the gross profit, if you remember. So the thing is, I could have found out gross profit as a balancing figure. But the thing is, I have one more thing in question mark. No? If I had closing stock, I could have found out gross profit. Or if I had gross profit, I could have found out closing stock as a balancing figure. But the thing is, I don't have two things. What to do? About closing stock, the only thing they have given is 2,35,000, and that is at sales price. Can I include closing stock at sales price? No. Problem. What to do? But am I supposed to find out actual gross profit, correct gross profit? No. I am supposed to find out GP margin. GP margin will be constant for all the sales. Guys, say suppose 10 units you totally have. The GP margin on each sale, say suppose GP margin is 20%. If you sell 10 units, the overall GP margin will be 20% only, no? If you say suppose you have sold only 1 unit, your GP margin will be 20%, because that one goods you have sold it at 20% GP margin. 20% GP margin. Say suppose you sell 2 units, your overall GP margin percentage will be same, still same. 5 units, GP margin will be same, because it's percentage, no? Percentage will always be same. Correct? So since I have closing stock at sales price, I'll do one thing. I'll assume this closing stock is also sold. Okay, because I want to find GP margin, no? So what I'll do is I'll add my closing stock. I'm assuming that this is also sold. So that is 2,35,000, because if I sell, I would have sold it at selling price only. So I'm assuming this is also sold. 2,35,000. I'm assuming. Right, because GP margin will be constant. Say suppose I'll give you what I'm trying to tell. So if selling price is 100 rupees and GP margin is 20%, so 20% on sales, it is 20 rupees. So your cost is sales minus profit. The cost will be 80. Okay, this is I'm talking about 1 unit. Okay, for 1 unit, if I want to calculate GP margin, how much? GP margin is 20, sales is 100 into 100, percentage is 20%. This is only for 1 unit. Say suppose I'm selling some 30 units, we'll see that the GP margin will be same. Sales price will become how much? 100 into 30, it becomes 3,000. GP gross profit 20 rupees into 30 units, it becomes 6,000. So it is 20 rupees, so 20 into 30, it becomes 600. Then cost will be 300 minus 600, it will be little calf wise, not value. So 2,400. Okay, 3,000 minus 600, 2,400 is the cost. Now let's find out GP margin. My total GP is 600. My total sales is 3,000 into 100. How much will be GP margin? Still it will be 20%. Guys, if all the units, if you are selling at same profit percentage, the overall profit percentage will also be same. And here in the above example, am I finding out the right gross profit? No, I'm finding out GP margin. So I'm assuming this closing stock is also sold. Will I get the percentage as same? Yes, I will still get the percentage as same. So I'm assuming that to be sold. Closing stock became 0 because I've assumed the remaining closing stock is also sold at selling price. Now, that means how much will be my gross profit? Can I calculate? Yeah, I got everything. GP margin I can find out as closing. So 2245,500 plus 2,35,000 minus 1696,340 minus 87,500. So remaining is 6,96,660. This is the profit. Now how to find out GP margin? I told gross profit. Gross profit is 6,96,660. Your total sales 22,45,500 will take. Hey, in my assumption, what has happened? I've sold the closing stock also. So 22,45,500 plus 2,35,000. So it becomes 24,80,500 into 100%. So how much is my GP margin? 696,660 divided by 24,80,500. So it comes to 28.09%. This is my GP percentage. I found out. Now I found out my GP percentage. Done. Enough. That's all. All this was just like working note to find out GP. Did I find out GP? Yes. Now I have to find out the cost. My closing stock at sales price minus profit I will get. So closing stock at sales price is 2,35,000 minus profit. I've got now the profit percentage is 28.09%. So 28.09%. Since GP is calculated on sales, what was the formula? Gross profit divided by sales, calculated on sales. So you can apply this percentage also on sales figure. Since closing stock is at sales price only, can I apply it? Yes. So 28.09% into 2,35,000. So how much is my profit component? 2,35,000 into 28.09%. We'll get 66,012 as profit. So remaining is cost. So 235,000 minus 66,012, that is 1,68,988 will be the cost of the closing stock. So did you understand how we found out the cost by using adjusted selling price method? Only this much is adjusted selling price. All this we did just to find out GP margin. And GP margin, how did we find out? In trading account, simple. Put one memorandum trading account, you'll easily get the gross profit. Easiest method to find out gross profit. Okay. Or one more method what you can do to find out gross profit is GP is equal to sales minus cost of goods sold. Okay. What is cost of goods sold? Opening stock plus purchases plus any direct expenses you have added minus closing stock. So here we had written a formula much before in our discussion. Okay, here please add direct expenses. Okay, very important. Here you remember while I was explaining COGS formula, opening stock plus purchases plus direct expenses minus closing stock. Here also plus direct expenses. Okay, that one thing you can add it off because direct expenses is also directly attributable. So we'll add it in the costing. So done, guys? Understood now? Yes. So now all the discussion relating to inventory for you to understand it in this video has been completely given. Okay. Now one more thing we can do is let's solve two more problems from inventory which I feel is important for you to know, and let's end this discussion. Okay. One more crazy question. This was asked in May 2025 examination also. So I thought I'll cover this. Can we start, guys? So let's discuss. Come on. A trader prepared his accounts on 31st March each year, and due to some unavoidable reasons, no stock taking could be possible till 15th April. Guys, generally they are doing periodic system of inventory taking. That means on 31st March, which is the end of the year, they'll do stock taking. But what happened, due to some reasons, they were not able to do the stock taking as on the end of the period, because in balance sheet or in final accounts, we will take closing stock of which day? As on 31st March, no. So that's why we'll do closing stock taking on 31st March, but this case what happened, they were not able to do it. Okay. When did they actually do? They did the actual stock taking on 15th April 2018. Okay. Now, from 31st April, March, till 15th April, many things would have happened. No? Now, for 31st March, if I take 15th April stock, is it correct? No. Between this period, many purchases could have happened, many sales could have happened. That movement and all should I consider? No, that happened after 31st March. I want the stock position as on 31st March. Now, what would have happened? Say, suppose some purchases would have happened between 31st March to 15th April. Can I add it in my closing stock as on 31st March? No. Sales happened after 31st March. That purchase, do you think will be added in the closing stock as on 31st March? No. So, whatever purchases is there, I should not consider. Say, suppose some sales would have happened in this intervening period, 31st March to 15th April. Okay. Goods would have gone out. Should I consider that gone out? No, that happened after 31st March. See, that between 31st March to 15th April, some goods could have gone out. Okay, in 15th April stocks calculation, do you think that goods which have gone out will be included? No, because it has happened during 31st March to 15th April, goods have gone out. As on 31st March, has it gone out? No, that tell me, if there are some sales that have happened from 31st March to 15th April, do you think I should not consider it in 31st March stock? No, as on 31st March you have to consider, because that was there as on 31st March. It left after 31st March. So I don't want whether it left after 31st March, that is different. As on 31st March these goods were there, yes, it was sold later. So those goods are added back. Purchases made in the intervening period, I don't want, and subtract. Sales made in the intervening period would have gone, but I don't want that to go back, because as on 31st March all those goods were there. So I will add it back. Like this, I have to make the adjustments and I have to arrive at 31st March's stock position. Okay, they have given various adjustments. I'll do it one by one. Okay, we'll start solving it now. So question number 9 anyways. Statement showing calculation of inventory particulars rupees. Okay. Now, what statement showing calculation of inventory as on, I want 31st March's stock position, 31st March. Okay, done. Now, we have 15th, see they have done the stock taking on 15th and they have got closing stock of 50,000. From there I have to arrive at closing stock of 31st March 18. So, closing inventory as on 15th April 2018, I've got 50,000. So they are telling during the intervening period, that means after 31st March till the date of actual stock taking, that is 15th April, some sales has happened. How much sales? 41. This includes cash sales of 10. Guys, bifurcation of cash credit doesn't matter here, it is just a biscuit. So total sales that I have made is 41. That means after 31st March, before 15, sales of 41,000 I have made. That means goods have gone out. As on 31st March, these goods were there. Yes, that means what? In the calculation of 50,000, which I did on 15th April, these goods are there. No, it is gone. So in calculation as on 15th April, it will not be there. But these goods which are sold in the intervening period were there as on 31st March. So what I have to do? From 15th stock taking, I have to add back the sales, because on 31st March they were there. So what I will do? Plus sales during 31st March 18. Okay. So how much?
41,000. Okay, this I am supposed to add because that is there, that was there on 31st March. In 15th April stock taking it is not there because sold, no, it is gone. So what I am doing, I am adding it back. So but 41,000 is sales price. Can I add? Can I consider? Calculate cost of inventory at sales price? No. So I have to remove the profit component. Have they given GP margin or gross profit? Yes, they have given GP margin 20% on sales. Sir, they have not told GP. How are you telling? See, 20% on sales means it will be GP margin because GP margin is also calculated on sales only. So 20% on sales. That means from 41,000 I will subtract 20%. So remaining will be 41,000 minus 20%. It is 32,800. So 32,800 I will add. Next, purchases, what I have to do? If sales I am adding back, then purchases happening in the intervening period I have to subtract. So minus. Because why? In 15th, these purchases which is made after 31st March before 15th April is included. But as on 31st these purchased items were there as on 31st March stock? No, that's why I am subtracting. So purchases during 31st March 18 to 15th April 2018. How much purchases have I made? 5034. Again, they have told including cash purchases. Guys, it's biscuit. Okay. That bifurcation doesn't matter. So 5034. Purchases will already be at cost only, so nothing to do. So 5034 I will subtract. Clear? Done, sir. Then we have sales return. Sales return, in sales return what will happen? I have made some sales, goods would have gone. Okay. Goods which have gone has come back from my customers between this period, 1st April till 31st March. Some goods have come back. Now what I have to do? The goods has come back later. As on 31st March these goods have come back. No. But as on 15th day stock taking, the sales return goods which has come back is included. So should I include it as on 31st March also? No, as on 31st March sales return only did not happen. Sales return happened after 31st March. But in stock calculation which we did as on 15th April, this will be included. I don't want it to be included. So what I will do? I will subtract sales return. Or one more thing for you to remember is sales is added back. Sales return will be subtracted. Sales return of how much? Sales return happening. So sales return is 1,000 rupees, but 1,000 is at sales price. No, sales is at sales price. Sales return also will be at sales price. I should not consider sales price for stock valuation. So I have to subtract profit. How much is the profit percentage? 20% on sales. This is also at that sales value only. So 1,000 minus 20%. This has become 800. 800 I will subtract. Okay. Next, these are the 2 points which you have to listen carefully. Okay. It is a little crazy, but focus. Now there is a concept called as goods sent on approval basis. So what is that? Guys, what will happen in approval basis? No. I will send certain goods to my customer. Okay, to his location. He'll be using it. If he likes it, he can keep the goods. If he doesn't like, he can send me back the goods. Simple. Okay. If he likes, he approves the sale, he can keep the goods. If he doesn't like, he can return it under goods sold on approval basis. Now tell me, when I've sold the goods on approval basis, I've sent some goods, okay, can I book the sales income? No, wrong. Because that guy is not approved only, no. If he had approved, we could have booked the sales, but that person has not approved only, so because of which we cannot book the sales income at all. Yes or no? 100% yes. Now what I will do is, this question or adjustment is based on goods sent on approval basis, so we'll see it from that angle only. Now on, you understood, no? Goods sent on approval basis. I have sent some goods on approval. I can record the sales income only when he approves it. If I don't know whether he has approved it or not, then I cannot record sales income. Even if I have recorded by mistakenly, I am supposed to reverse it by the end of the period because I have not yet received the approval. Done. Now, if you come here, on 15th March, goods of sale value of 10,000 were sent on sale or return basis. That is goods sent on approval. The period of approval being 4 weeks. Guys, one more thing. Within 4 weeks, I'll ask him to approve it or not. If he approves, I'll book the sales income. Within 4 weeks he did not tell anything, and the 4 weeks elapsed. I have offered him 4 weeks. Within 4 weeks he is supposed to say yes or no. Within 4 weeks he does not say yes or no. Then the moment 4 weeks is elapsed, automatically it is deemed that he has accepted. I will book the sales income. Okay, that is the rule. Now, on 15th March, the goods of the sale were 10,000. We are finding out closing stock as on 31st March. On 15th March only we have sent some goods on approval basis. This is sale value 10,000. Okay. Period of approval was 4 weeks. He returned 40% of the goods on 10th April. Okay, so out of 10,000, okay, 40 he returned back. Okay, when 10th April. That means while taking 15th April stock taking, this 40% is included. Yes, that is there. Remaining 60%, that guy has approved. If he has returned 40, then remaining is what? Remaining 60% he has approved, and the customer was billed on 16th April. Okay, the next day after taking the stock. Now tell me, what should be our position as on 31st March is what I am asking. Now as on 31st March, on 15th March only I sent the goods. On 31st March, I did not receive any approval. 4 weeks is also not elapsed. That means, do you think I have to book the sales income or not? As on 31st March, if I have not received any approval, that means I am not supposed to book the sales. Okay, now tell me guys, there is something in opening stock, something in purchases. This either you have to sell it further. If you have not sold it in the current year, it should come in closing stock, yes or no. There are some goods in opening stock, some goods you have purchased. This should either be sold, if not sold, should be lying in closing stock. Now with respect to this 10,000, am I including it in sales? No, I am not including it in sales, because what has happened? As on 31st March, I have not received approval only, so I would have not included it in sales. That means what? I have to include this in closing stock. That means as on 31st March 18, since I have not received any approval, entire thing should not be booked as sales. All that, though it is lying, all that goods, it is lying in the customer's place, I have to include it in my closing stock, saying that goods lying at customer's premises. So 100% of the goods that are sent, which is 1000, which has a sale value of 10,000, that should come in my closing stock. Okay, that is the idea now. Now I have to add back goods lying with the goods sent on approval basis. Entire thing I have to add. Why? Because as on 31st March, I did not receive any approval. So I cannot book sales income. If I cannot book sales income, everything should be there in closing stock. Okay. Now goods sent on approval basis. How much? 10,000 is the sale value. Will I consider 10,000? No. I have to subtract profit. So minus 20% profit. If you subtract, you will get 8,000. Will I add back entire 8,000? No. Still catch is there. What happened? Out of I would have added 100%. But on 10th April, he has returned 40% of the goods already. So you are supposed to add back 100, but 40 is already returned now within 10th. So that 40 is already considered in 15th April stock valuation. 40 has already come back. That 40 will be considered in 15th April's actual physical stock take. Yes or no? 100% yes. So 40 is already considered. So how much I should add back to become 100? I was supposed to add back 100 only. But the thing is, 40 has already come back by 10th April, which is considered in 15th April valuation. So remaining only I am supposed to add back. Out of 100, 40 has already come. That means I have to add back only 60%. So 8,000 to 60%, I'll add back only 4,800 rupees. Understood? Done. Next. Okay, last point. The trader had also received goods costing 8,000 in March for consignment. 20% of the goods have been sold by 31st March only. Another 50% is sold by 15th April. These sales are not included in above sales. Okay. Now for this you are supposed to understand what is consignment. Consignment means, guys, say suppose my business is there in Karnataka. I want to also sell my goods in Maharashtra. But to set up a branch there, it takes a lot of money. All that I cannot do. What I'll do, I'll find one agent in Mumbai. I'll tell, hey, I'll send my goods to you. You see, if you can sell, sell. If you cannot sell, just send back the goods to me. Okay. For that guy, I will give him commission for whatever sales he has made. But he does not have inventory basis. That means if I send something to him, if he can sell it, good, earn commission. If you cannot sell, you can send it back to me. Now tell me, who has the ownership? In case of consignment, the ownership is still with me only. Okay, the principal. Though I have sent him the goods, the possession is with him, but the owner of the goods is still me only. Now, did I sell goods to my agent? Yes, agent in consignment is also called as consignee. Okay, the guy who is sending the goods is called consignor. The guy who is receiving the goods and selling on behalf of this consignor is called consignee. Okay, that guy gets commission. He is just like my agent. When I transfer goods to my agent, my ownership is transferred to agent. No. We both are as good as one and the same. Ownership is with me only. Now, if ownership is with me, that closing stock should come in my books or agent's books. Whoever has the ownership, closing stock should come in their books. Correct? If I have the ownership, in this case, I am the consignor, I have the ownership, so closing stock should come in my books. In consignee books, should the closing stock come? Say, suppose you are consignee. You have received some goods from someone to sell it. If you cannot sell it, you send him back. That goods which you have received as a consignee, do you think will you add it in the books of consignee as closing stock? No. Because the ownership of such goods is not with consignee, it is with consignor who has sent. Correct? No, if I cannot sell it, I send it back to him only. No? So in this case, what happened? Our trader, our guy, he has received goods of rupees 8,000 for consignment. That means what? Is he consignee or consignor? If he has received the goods, that means this guy is a consignee. Now he has to sell on behalf of consignor. If he can sell it, earn commission or give it back to consignor. So what has happened? He has received total of 8,000 in March. 20% he has sold it by 31st March. 50% he has sold it by 15th April only, by the date of our stock take. That means still 30% is out of 100%. 20 is already sold by 31st March only. 50 is sold by 15th April. So how much will be there as on 15th April stock taking? 30% will be there. This 30% is already there in closing stock, because stock taking, how it would have happened? You would have directly go down and you would have counted. Do you think you would have subtracted? No. Bifurcated the goods saying that this is mine, this is consignor's. No. He'll directly do the stake talk. Do the stock take. He'll directly go and do the stock take. There, consignor's goods is also included. Am I supposed to include consignor's closing stock in consignee's books? No, because it is his books. I have to subtract. So totally I have received 8,000 rupees. Out of that, 20 plus 50, 70% I have already sold. That means it's not there in closing stock. How much is there in closing stock? Only 30%. That 30% I have to exclude in the books of consignee, because the ownership is still with the consignor. Consignor stock. Consignor means who? That guy who has sent the goods for me to sell. If I can sell, earn commission or send it back. This is not my goods because ownership is still with consignor. I have his goods worth 30%. That I cannot include it in my stock. Sir, who told it is included? On 15th April we did counting. No, there we have already counted that also. Because when you go down, do you think you would have made separation? No. Everything you would have added and he has got 50,000. But out of that, consignors I should not consider. That I will subtract. I would have subtracted entire goods received on consignment. Okay. I would have subtracted everything, but this entire thing there as on 15th April stock taking, no, 70% is already gone. 20 by March, 50 by 15th April, 20, 50, 70% already gone. Only 30% is there. So why will I subtract entire 100%? So I subtract only 30%. So how much I have? 8,000. So 8,000. Okay. Out of this 8,000, 70% gone. Only 30% I'm supposed to subtract. So, and it is already at cost only. They have told goods costing. So 8,000 to 30% I subtract 2,400. So closing stock as on 31st March 2018 is, please add everything and see, 50,000 plus 32,800 minus 5034 minus 800 plus 4,800 minus 24. So your closing stock will come up to 79,000. Correct? It will come up to 79,366. What people? Dana? Understood the entire calculation what we did? Very much clear?
So it is 79, 366. Done. So with that said, let's confirm the answer also once. Okay. So it is 79,366, correct.
So done. So that's about it, guys. So I think we have discussed inventory chapter a little bit more in detail only, and I think that this discussion has helped you to understand inventory better. If you feel I have to solve more questions, if you feel that if I want to solve more questions for you from inventory, what you can do is please comment down and let me know. I will definitely solve it for you. And if you have understood inventory better from this video, then please drop a like, subscribe to this channel, and I'll come up with more videos. If you want to get that notification whenever we post a new video, please don't forget to press the bell icon, subscribe to our channel, and please comment, like, share, do whatever you want, and please show some love, because that is what keeps us going. Thank you, guys. See you in the next video. Till then, all the best for your exams. See you in the next one. Bye, guys.